think that the biggest fear for most first time homebuyers is whether or not they're even going to qualify to buy a home in the first place. And that entire process starts with getting pre approved for a mortgage. So, in today's video, I'm going to give you guys the best tips and tricks that I've got to make sure that you can get pre approved this year if you want to. Many first time homebuyers will jump immediately onto realtor.ca or House Sigma, or they'll connect with a realtor and start looking at homes before they've even considered their finances. This is probably one of the biggest and most common mistakes that you can make because you want to make sure that you have your financial house in order before you start looking at and potentially falling in love with homes that may not actually work for you once you've had a chance to crunch the numbers. Now, the first thing you want to do is pull your own credit report before you head in for the pre-approval. Not just looking up your credit score on one of the many apps you can do it on or on your online banking, your actual credit report. And in Canada, that means paying $10 or $20 to go to Equifax or TransUnion to get your up-to-date report. The reason this is so important is that errors on your credit report are more common than you would think. Whether it's old debts or accounts that you thought had closed, if there's a problem, you want to find it now, not when you're sitting across from the lender and it's a surprise. Fixing issues on your credit report can take 30 to 90 days at a minimum, sometimes longer. So you want to make sure you catch this early if it is going to be an issue so it doesn't stop you from buying a house in the timeline that you want to. What you're looking for when you get your credit report is any accounts that you don't recognize, any debts that are showing up as unpaid that you're pretty sure you had paid off already, old collections reports that should have dropped off by now, and most importantly, your credit utilization ratio. You want to see how much of your credit you're actually using, as this is something that's really important to the lenders. The bottom line is you want to walk into your pre-approval conversation knowing exactly what the lender is going to see so there's no surprises once you get there. Point number 2 is making sure you get all your documents in order in advance. Going and getting a mortgage pre-approval isn't just a conversation with your lender. They're going to ask you for supporting documentation. And if you don't have this ready to go, the process can be a lot slower and more painful than it needs to be. What you're typically going to need to get started is income confirmation, which takes the form of 2 recent pay stubs, or a letter of employment. You're also going to need your most recent notice of assessment from CRA. T4s and your T1 general from CRA are also items that the bank will ask for a lot of the time. You'll also need bank statements showing that you have the down payment in order to buy the house. If you're somebody who's self-employed, you're going to need probably 2 to 3 years of financial statements with your notices of assessment and that sort of thing. And it's even more important that you have everything in order when you're applying from this position. Point number 3 is make sure you have at least a basic understanding, a rough idea of what you can afford before you head into the appointment. I'm talking in terms of monthly payment. What the lender is going to do is take all the documentation that you gave them and put you through a stress test, which right now means you have to qualify based on your contract mortgage rate plus 2% or 5.25%, whichever of those two is higher. And they'll tell you based on that what your maximum amount is that you can spend on a house. But the thing is, this maximum number assumes that you're okay with being stretched thin. It doesn't account for your actual lifestyle, your spending habits, future expenses like kids, replacements to your car, home maintenance, and the fact that property taxes, utilities, and insurance in Ottawa can add up from $500 to $800 a month pretty easily. So what I'd suggest you do is before you sit down and talk to anybody about your pre-approval, look at what you're spending right now on rent, discretionary stuff, savings, and ask yourself, what monthly payment would I be comfortable with? Not just what can I technically survive on. I have seen people before who got pre-approved for $650, and especially when the market was crazy, they bought at the top of their pre-approval, and after they moved in, they realized they couldn't do any of the other important things that they usually wanted to do. As a general rule, and this does not take into consideration your individual circumstances, you probably don't want to be spending much more than 30 or 35% of your gross monthly income on your mortgage payment. Point number 4 is decide between whether or not you want to go to a mortgage broker or a bank, or try out both. This is a question I actually get a lot, and the simple answer is banks offer only their own products. That's it. They're not going to tell you if the competitor has a better rate. Brokers will shop around for you and look at different rates on your behalf, trying to find you the best deal. Now, this doesn't mean that a mortgage broker is always better. There are circumstances, especially if you have a long relationship with the bank and they want to keep your business and keep you happy, they can beat the rates the mortgage brokers will give you. If your situation is straightforward, you have steady income, good credit, and they want to keep you around, this can often be the best option. It can also make sense to go to a bank once you've already done your own rate shopping and you have a couple offers on the table to be able to take to your bank and say, hey, can you beat this? I've seen this work really well for some people. Now, with that being said, there are many situations where a mortgage broker could be the better option. If you're self employed or have a non traditional income, mortgage brokers offer a lot of different flexible options as far as which lenders they can go to. If you have any issues with your credit, the mortgage broker can be a better option too. And if you don't want to do the negotiating on your own, a good mortgage broker is going to do that for you. They're going to call the lenders that they know and get you a competitive rate without you having to juggle all of that yourself. The bottom line here is it doesn't cost you anything to talk to both a bank and a mortgage broker. The brokers do get paid by the lender, not by you, so you're not paying anything out of pocket, and they'll show you the final rate that they're going to give you so you can make a decision based on that. I normally recommend that people shop around. If they have a good relationship with your bank, go talk to them, but it's also worth having a conversation with a mortgage broker to see what they can offer you as well. Point number 5 is absolutely critical, and this is don't rock the financial boat leading up to your pre-approval. This one can catch people off guard. I've seen people buy cars or take out loans before going to get their mortgage, and it can really ruin what you might qualify for. Things you really want to avoid are opening new credit cards or lines of credit, making large purchases if you can avoid it. Think cars, appliances, furniture, that sort of thing. Co-signing for anyone else on a lease or anything like that can really hit your credit as well. Changing jobs can also be something. Even if you're moving up to a higher salary, if you're going to be in a probationary period, that's something that can really set you back as far as your pre-approval. A lot of the times lenders will want you to be out of your probationary period at your new work before they'll give you the pre-approval to buy the house. As a general rule of thumb, if it's going to affect your credit report at all, or you think it might affect your credit report, hold off until after you've got your pre-approval and after you've purchased the home. Planning for and getting everything organized for your mortgage pre-approval can be one of the hardest and most stressful parts of the process if you don't prepare properly. If you take this advice to heart, I promise this will make it easier for you. Thanks so much for watching. Have a wonderful day and take care.